Hey crypto fam! Welcome back to the channel. Today, we're diving deep into a topic that sends shivers down the spines of many crypto investors, the IRS and your digital assets. We all know the IRS wants its cut, but what if I told you there are things they don't actively publicize, strategies you can use, and pitfalls you must avoid to keep more of your hard-earned crypto and stay on the right side of the law? In this video, we're going to break down the key crypto tax rules, expose some common misconceptions, and reveal legitimate strategies to minimize your tax burden. Stick around, because by the end of this, you'll be far more confident in navigating the complex world of crypto taxes. First things first, let's establish the IRS's baseline. They treat cryptocurrency as property, not currency. This is a crucial distinction. What does it mean? It means every single transaction you make, selling, trading, even using crypto to buy goods or services, can trigger a taxable event. The IRS categorizes gains as either short-term or long-term. Short-term capital gains. These are for assets held for 1 year or less, and they're taxed at your ordinary income tax rate, which can be as high as 37%. Ouch! Long-term capital gains. Hold onto your crypto for over a year, and you qualify for significantly lower rates, 0%, 15%, or 20%, depending on your income. This is your first golden nugget, folks, HODL for over a year whenever possible. Beyond capital gains, earning crypto through mining, staking, airdrops, or being paid in crypto is generally treated as ordinary income. The fair market value in USD at the time you receive it is what you report. The IRS definitely wants you to know that they're serious about crypto compliance. They've been updating their guidance, and come January 1, 2025, a new era of reporting begins with Form 1099-DA. This form will be issued by digital asset brokers, think centralized exchanges like Coinbase, Binance, US, and Gemini, to both you and the IRS for transactions occurring in 2025 and beyond. This is a massive shift. Historically, a lack of comprehensive reporting made it easier for some to fly under the radar. Not anymore, or at least, it's getting much harder. The repeal of reporting obligations for decentralized finance, DeFi, brokers under recent legislation offers some relief for those interacting solely on permissionless blockchain protocols. However, it's critical to understand that this doesn't eliminate your individual responsibility to report your transactions. The IRS is still watching. Blockchain is transparent, and they have sophisticated tools to analyze it. They're also asking the crypto question on your tax forms, Form 1040, etc. You must answer this accurately. Answering no when you should have answered yes is a red flag and could lead to serious consequences. Alright, now for the good stuff. While the IRS wants their taxes, they aren't going to hand you a playbook on how to pay less. That's where smart tax planning comes in. Tax loss harvesting. This is your secret weapon, especially in volatile markets. If you have crypto that's decreased in value, you can sell it at a loss to offset capital gains from other crypto sales, or even up to $3,000 of your ordinary income. Graphic, tax loss harvesting, with a scale balancing gains and losses. Host, realize those losses strategically before the end of the tax year. You can then rebuy similar assets after 30 days. To avoid the wash sale rule, though specific crypto guidance on this is still evolving, it's best practice to assume it applies. Long-term gains preference. We touched on this, but it bears repeating. Holding your assets for over a year is the easiest way to slash your tax bill. The difference between 37% and 0%, 15%, or 20% is astronomical. Patience pays off. Specific identification method. When you sell a portion of your crypto, the IRS often defaults to first in, first out, FIFO, meaning they assume you sold the oldest crypto you owned. But what if your oldest crypto had the lowest cost basis, leading to a higher gain? Graphic, FIFO versus specific ID, with example scenarios. Host, if your exchange or wallet allows it, you can often use the specific identification method. This lets you choose which specific units of crypto you're selling. If you bought Bitcoin at $10,000, then $20,000, then $50,000, and now it's at $40,000, you could sell the $50,000 lot to realize a loss, or the $20,000 lot to realize a smaller gain, instead of the $10,000 lot. This requires meticulous record keeping, but it can save you a ton. Gifting crypto. You can gift up to $18,000 for 2024, rising to $19,000 for 2025, per person per year without triggering any gift tax for the giver or income tax for the recipient. If the recipient then sells it, they pay taxes on the appreciation from your original cost basis. This can be a great way to spread gains among family members in lower tax brackets. Graphic. Gift crypto tax-free, with annual exclusion amounts. Donating crypto to charity. If you donate appreciated crypto directly to a qualified charity, you generally don't pay capital gains tax on the appreciation, and you can still deduct the fair market value of the donation. It's a win-win. Now, let's talk about what the IRS really doesn't want you to mess up on, because it will put you on their radar. Failing to report any crypto activity. This is the biggest one. With 1099-DA coming, and blockchain analysis, simply ignoring your crypto transactions is a recipe for disaster. The IRS knows more than you think. Graphic. Audit triggers, with no reporting highlighted. Miscalculating cost basis. This is where many people get tripped up. Your cost basis is the original price you paid for your crypto, plus any fees. If you don't track this accurately for every transaction, you'll likely overpay or underpay your taxes, both of which can flag you. Graphic. Cost basis confusion, with buy price plus fees formula. Host. The IRS is shifting to a wallet-by-wallet accounting requirement starting January 1, 2025. Gone are the days of lumping everything together. This means meticulous record keeping for every wallet you own. Not reporting all income events. Remember staking and mining rewards. Many people forget to report these as ordinary income when they receive them. The IRS considers them taxable at the moment you earn them, not just when you sell. Inconsistent reporting across exchanges, wallets. If you're using multiple platforms and not consolidating your data, you're making it incredibly hard on yourself, and increasing your chances of discrepancies that the IRS will catch. Ignoring IRS letters. If you receive a notice 6371, 6374, or CP 2000 from the IRS, do not ignore it. These are serious, and addressing them promptly and accurately is crucial. So, what's your takeaway? Track everything, seriously, every single transaction. Date, time, asset, amount, USD value, purpose of transaction. This is non-negotiable. Utilize crypto tax software. Manual tracking for complex portfolios is a nightmare. Tools like CoinLedger, Coinly, and TaxBit can connect to your exchanges and wallets, automate calculations, and generate the necessary tax forms. Form 8949, Schedule D. This is an investment that pays for itself in time and peace of mind. Graphic, logos of popular crypto tax software. Consider a tax professional. For complex situations, or if you just want to be absolutely sure, consult with a tax professional who specializes in digital assets. It's better to pay for expert advice than face an audit or penalties. Educate yourself. The crypto tax landscape is constantly evolving. Stay informed about new regulations and guidance from the IRS. The IRS is no longer playing around with crypto. While they're getting more sophisticated in tracking, understanding the rules and employing smart, legal strategies can significantly reduce your tax burden and keep you compliant. Don't let fear or confusion lead to costly mistakes. Be proactive, be organized, and be informed. If you found this video helpful, smash that like button, leave a comment with your biggest crypto tax question, and subscribe for more insights into the world of digital assets. Until next time, stay safe, stay decentralized, and stay tax smart.